Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Matt Gertkin. How you doing today, Matt?
I'm doing all right. Thanks, Kirk.
Good. Well, I wanted to bring Matt on the show because we are going to have a really interesting 2024, and with a lot going on. And I wanted to bring on somebody who's really strong in the macro strategy department. So, Matt, maybe you could tell us a little bit about your background.
Yeah, thank you. Well, so I started at strategic forecasting, otherwise known as Stratfor, which is based in Austin, Texas. And I learned the ropes of geopolitical strategy. I then joined on at BCA Research in 2015 with the geopolitical strategy, which was a very unique product, which was begun by a good friend of mine, Marco Popic, who has written sort of the locus classicus on geopolitics and financial markets. And at BCA, we were really trying to combine these different forms of study. I mean, macro investing with geopolitical analysis. And then in 2021, I launched a US political strategy, which is sort of a complementary product to go along with the geopolitical strategy so that we can cover the events happening in the US, which have taken on such importance in the political sphere.
Yeah, I mean, obviously in 2024, we have a presidential election, which, if nothing else, will be entertaining. And hopefully it comes out in the benefit of everybody, whatever it tends to be. But maybe you could talk a little bit about how people are looking at that. How are they handicapping it? Like, what are the impacts going to be with for investors and the economy?
Well, I think from an investment point of view, it's extremely important to be nonpartisan, and we have to sort of purge ourselves of any partisan leanings, be prepared for any outcome. And what that means, in a way, is taking a geopolitical approach to the United States. So you pretend you're a geopolitical analyst and you live in a different country. And basically, what you're looking at is first of all, a major asymmetry in the potential results, because if Democrats win the election, they might retain the White House, but they will very likely still lack one house of Congress, whether it be the House or the Senate or both. And that means that their domestic legislation will be gridlocked, and they won't be able to significantly change the US economic structure or distribution of wealth without Republican support. So it would be bipartisan if they did legislation, and therefore not radical or enormously disruptive. And that's a different outcome from if the Republicans win the White House, because in a scenario where Republicans win the White House, they also very likely take the Senate, and they already have the House. So in that situation, you have single party rule, and single party rule means that you can have radical or disruptive domestic legislation. And that's not to mention another important element, which is that foreign policy would be unorthodox, to say the least, under President Trump if he were in fact a candidate. So I think the key asymmetry there is that Democrats lead to gridlock, which is generally better for the markets, whereas Republicans lead to single party rule, which has in fact the worst outcomes in terms of market returns over a presidency.
Okay, no, that's interesting. So, um, one concept that always kind of comes to mind. My dad always used to say this when I grew up. I used to, worry about things that I have no control over, which is never a good idea. But you worry about the state of the world and all that. And what he used to tell me is that it's like a pendulum. It goes extreme in one way, and then it goes extreme the other way. It goes back and forth. So it's never going to continue going in one direction, but it will inevitably go back the other direction. It feels like that's what's happening. We went to the extreme left in some ways, and now it's starting to swing back with some of the stuff going on. So how do you see that playing out domestically in terms of markets?
Yeah, it's an interesting point. I mean, and we're all familiar with this analogy, but I think we have to be cognizant of the differences with the current situation in the US. We're not having a normal election between just two parties, like a two-party duopoly, where their establishment elites and their policies are generally continuous with each other. This is more of a fundamental rupture in the social fabric or in the political fabric, and it stems from a long brewing sort of dissatisfaction in the US over globalization and inequality. And it's very different from what we see in other developed countries like Canada or Germany. You can maybe compare it to what happened in the UK, where they've had a pretty big break. But even there, it's maybe not as extreme in the US. So what I'm saying is a pendulum assumes that you have a fixed point, and even though you get these big swings one direction or the other, the pendulum doesn't actually break off and go flying in some direction, right? I think the problem with that is that you could have the pendulum really break in the US. You could have constitutional rupture. You could have domestic terrorism. You could have significant breakdown in law and order. So these are historic developments in the US, and they're different than just sort of a normal handoff between a generic Republican or a generic Democrat.
I mean, yeah, I mean, there's a lot of assumptions built in there, and I wonder, like, how would that vary compared to what we've already seen? You know, like if we're going to assume Trump wins for a moment, because Biden, we kind of know what we're getting right now. So let's say it's Trump, which I think the stats show that no one else is going to really have a chance. They're not even close on the Republican side. So let's assume it's him. So, I mean, we've already seen him in the White House. So how do you kind of have seen him, right, in 4 years and what he's done? And obviously there's populist movements globally, right? Like a bunch of other countries are seeing the same thing. How do you kind of look at that? I would think it would be easier to handicap that and predict, because we've already seen some of the things that he's focused on. So how do you kind of see those playing out, especially if we
Yeah.
have a one-party rule?
Yeah, I think it would be a different the second time around. I mean, first let's just say structurally, and this is not some sort of anti-Trump diatribe either. I just mean that structurally, second-term presidents have a different framework that they exist in. They don't have to worry as much about the economy because they can't get reelected. So that means that they have a tendency to express themselves more in foreign policy and to pursue long-term American interests, or what they perceive to be long-term interests. And that can be more disruptive for the economy because it can involve other things like national security. And the US has these enormous national security challenges abroad. Trump would be interesting. You know, I think he would look to sort of make a ceasefire in Ukraine, as he has said, and that could be viewed as a positive. But at the same time, he would pursue a very aggressive posture toward Iran, which means that we could have Middle Eastern oil shocks. And that was the trajectory that he was on during those 4 years. So I am drawing from that record of his. Um, but also with China, you know, he pursued a trade war with China, and I think he would double down on that trade war. And China would be intimidated in the context of not only tariffs, but Trump would be likely to continue the Biden administration's policy of shutting off their access to the most advanced computer chips. So these are factors that can escalate, and they can escalate under Biden as well. He would also be a second-term president. It's just that Trump introduces these fat tail risks. If he withdraws support from Ukraine, that emboldens Russia and emboldens China. And yet then if he pivots and tries to defend Taiwan, say, or tries to defend Israel, these are effectively mixed messages, and therefore they create more unpredictability in US policy and therefore more global uncertainty. So it's not necessarily a view of, you know, Trump just being uniquely bad or something like that. It's just that he's unpredictable, he's unorthodox, he's eccentric, and those factors then cause other countries to be much more, you know, they could react in different ways, but it would be more chaotic. Last thing, he also would be very dedicated to restricting immigration, which of course many people in America think needs to be done, and the Congress would be supporting him if he wins. It would be a Republican Congress. But that's a major change in US policy. The US for decades has allowed very large immigration, and it's been a factor supporting our potential GDP growth. So if we have a reduction in labor force growth, that will impact the economy in a way that's different from past, past elections.
Yeah, it's interesting you say that, because I think it's while the rhetoric might be different, I think it's pretty much been a bipartisan support of more immigration, right? I think even under W, he was anti-immigration, but yet he did nothing to stop it. If anything, he made it easier for people to get into this country. So, you know, it is an interesting fact that I want, in some ways, I wonder it gets a little too caught up in rhetoric because I think we all, from an economic standpoint, understand that you need population growth or it messes with the economy. But I think no one wants to talk about how to do it right. They're just either for or against, and there's no middle ground. But it kind of brings in this aspect of globalization, and you had mentioned this earlier, especially with China. But Trump more or less set the path for deglobalization, even though I think there's probably support for it before that, and just never happened. But we're not moving from that path, right? So how does this play out long term? Because globalization caused low inflation, cheap goods, all that stuff that we benefited from, and now it's reversing, which is going to be painful. So how does this kind of play out in your viewpoint?
Yeah, I think you're right. I think that Trump sort of brought the attention to the world on this of this, reaction against globalization, but he wasn't the sole factor. He was sort of a catalyst of a movement that began with the Great Recession and the deleveraging of the American consumer and the shift from China away from export orientation. These are all really important developments. And Russia, of course, then their wars resulted in sanctions with Europe, so they've disengaged their economy from Europe pretty substantially, and Europe retaliating. And so what we see is that it is a fact that the Russian share of European imports has declined drastically, and the Chinese share of American imports has declined drastically. And we also see that it's hard to push up the overall trade intensity of the global economy now. It was at a very high level, and we have these disruptions suggesting it can be pulled down. So I think these are all, first of all, these are empirical points. It's not really so much about the narrative. I don't like the term reglobalization that some people use because it implies that the overall pie is going to be growing because of breaking down supply barriers, and that's not happening. So I agree with you. Deglobalization is a little bit better, but the term I really like is, well, I mean, the term I'm promoting, I coined it, is hypo-globalization. And what the point is there is that we're not truly seeing deglobalization yet. We might end up in a direction in which the world is rapidly reducing the trade intensity. But what we see in the data is that trade intensity is just kind of moving sideways. And so, in other words, globalization has clearly peaked, and the people who argued that it would, they were correct. But then we haven't had a collapse either. And in fact, the collapses in globalization have tended to be preludes to world wars, and that's certainly possible with the tensions that we see with Russia and China. But I'm not willing yet, even as a geopolitical analyst, I'm not willing yet to conclude that that's the track that we're on. I think those are downward spirals that we really are sort of skirting on, but have not yet begun. So, bottom line, the way I see it playing out is I think it's critical about U.S. policy. First of all, this is one reason the election is important. The Biden administration has co-opted a lot of Trump's policies and has been more protectionist, but it still has a general openness toward U.S. allies. Whereas what Trump would introduce is the possibility that the U.S. could be protectionist against allies as well as rivals, which would then unleash a sort of protectionist race to the bottom around the world, or it certainly could do that. So I think that risk has to be sort of encountered first. In addition, U.S.-China relations, I don't think they are going to re-engage at any point in the near future, primarily because Russia and China are cooperating so closely that the U.S. no longer has the ability strategically to re-engage China. So I think this does push investment into other China substitutes, India, Southeast Asia being leading substitutes, but also Mexico being a key beneficiary. And I think those trends are durable, and the narratives that are sort of coming out from that are the right narratives.
Okay. I mean, this also plays into the element of inflation, right? Because, globalization allowed us to export our inflation to China. And now that's, if not shrinking, at least flatlining, it is increased inflation. It has kind of pushed it back on shore. And we've seen that through, various methods. But the predicting inflations right now is pretty tricky. So how do you look at inflation, US wise? Because I know obviously other countries have their own problems, but how do you look at inflation globally as well as domestically?
Yeah, well, it's always been very difficult to predict. And what I would highlight is that, first of all, over a very long-term period, looking at both the US and the UK, so that we're not sort of relying only on one example, we have good data for inflation. And what we've seen is that it's really catapulted in the 20th century since the World Wars. So basically, when governments abandoned the gold standard and they started printing money to their sort of heart's content in order to deal with challenges, right? The peoples of these nations had to deal with these enormous challenges like the Nazis or the Soviet Union. But the result was an expansive monetary policy to deal with the need to maintain social stability and expand the social sort of way of life of the countries, but then also expand their defense and technological capabilities. And the result was, higher inflation over the long run. And this has been very clear in the US as well since we got off the gold standard, or I guess you could say close the gold window. And so what it starts to do now that we've seen inflation make a comeback is it starts to put the period of disinflation into a box. We can sort of see in retrospect now that the period from 1980 to 2020 was just a phase, not necessarily a permanent phase. And we have to ask ourselves, how will policy affect these, inflationary, deflationary factors? And what I'm seeing is that policy is quite inflationary. So 2024 may be different. The Fed is acting and it has acted, and we may see inflation come down. But when we look multi-year basis, what we see first, governments still control the money supply, and the U.S. certainly has a very well demonstrated pattern of inflating away its debt. And then we see that budget deficits will remain very high because neither of the two political parties is anywhere close to endorsing a sort of austerity, a fiscal austerity. And then we're going to add these new factors like protectionism, restricting immigration, breaking up with China. And then finally, I think there will be conflict in the Middle East expanding well beyond, Gaza. And that's a multi-year basis, but it does imply oil restraint from that region. So when I put all these things together, to me, it looks like an inflationary backdrop. And I think, there are technological advances that can reduce that, and maybe we can talk about that. But the key point is, will they come in time to sort of rescue the economy from very clear and present inflationary dangers? And I would say that might be wishful thinking.
Yeah, so it's funny because every time I start talking about inflation and I hear responses, it it brings up the 70s all over again. It feels like there's so many different factors that are very similar to the 70s. You're talking about an oil shock, high inflation. How do you ever go back and look at history and look at the factors going in and say, hey, this is a very similar period, and here's why it's similar. Do you do that in your analysis, or how do you kind of look at that?
Yeah, absolutely we do. And that is one of the analogies. So what happened in the 60s was Johnson's Great Society, so an expansion of the social spending. And then combined with a war, and it was it was a major war. The Vietnam War was a major war for the U.S., and it just involved an enormous amount of spending, but also it tightened the labor supply. Uh, and then of course, when it really took off was in the 70s. Once you had tight labor markets and once you had inflation start bubbling up, then there became a political question because the Federal Reserve was struggling at that time with credibility. It's easy to sort of point to the Fed chair, Arthur Burns, and just say that he was a political stooge, but it was a little more complicated because what happened is he knew that if he tightened monetary policy that he would cause unemployment to go up and that this would also jeopardize the Fed's credibility. And I think that's an analogy for today. I think we live in a world where people will blame the Fed for causing a recession and pushing up unemployment. They may not really be as worried about inflation right at this moment. They were, say, last year, maybe this year, but if we look on a long-term sort of consumer expectations, it's not as if people are really panicking about inflation right now. So they could be inclined to say, well, let's not have a recession, and that would percolate and would pressure the Fed. Um, Basically the Fed has a dual mandate, and they have to maintain maximum employment as well, and they might lean that direction given that there's a dovish consensus on the FOMC in the wake of the Great Recession. So I think those are important points to consider. And finally, you're exactly right. I mean, oil shocks are very relevant here. Iran is pursuing a nuclear weapon, and that's the driving destabilizing factor in the Middle East. And the US had been pursuing negotiations with Iran. We can get into this, but I'm just saying that if you were on a track of US Iran negotiations and freezing the nuclear program, then you would expect the region to be more stable, and that would be more conducive to global oil supply, and that would be disinflationary. But if you can see a clear destabilization where the US and Iran fail to engage and Iran pursues a nuclear weapon, that suggests regional instability and more oil constraint and higher prices. So putting those things together, to me, and again, these are the analogies to the 1970s, and there's new features today, like the divorce from China. So I think it is an inflationary backdrop.
So one thing that I find fascinating is I try to think about the markets in the simplistic form possible, because they're so complex. There's so many different factors, and you never know which one's going to be the one that moves the needle. But I always think about, like, what's the one thing, if this changes, will impact everything. And for me, I look at it as, what's the Fed going to do, right? Because for decades, the answer is we go into recession, the Fed lowers interest rates to zero, and they just print money until the markets go back up. Then they stop, we go into recession, repeat, rinse, and repeat. But I feel like this time is a little bit different. If you look back in the 70s, like we're talking about, Powell wants to be Volcker. He doesn't want to be Burns, right? He doesn't want to be perceived as Burns. He wants to be the powerful Volcker all over again. Largely because if you're a Fed chair, you don't need money. You want legacy, right? You want name recognition. So I have to think that plays in. So I'm curious, but I don't have the answer. I just, this is my thinking, is that he's got some bias there. But how do you think that's going to play out? Because they're in a corner right now, right? Like they send us into recession, and then they lower rates, and then inflation spikes. So they don't want that, and the soft landing, the chance of that happening is same chance as aliens coming down and giving us a Valentine's Day card. So what do you see as a potential outcome here for this kind of painted corner that the Fed is in?
Yeah. Well, let me start with just a geopolitical point of view, which is maybe not to try to focus so much on Powell. And I'm not saying, that your approach is entirely wrong, because we all focus on Powell. I'm just saying that maybe we can help our analysis by looking at the FOMC as a committee, and that's where we see that this sort of whole context changed. And, that this group of folks has been really worried about the zero lower bound for most of the past 15 years. And so somewhere deep inside, they believe that if inflation, rises, well, they can always hike rates higher. The problem with deflation is that you can't go lower than zero. And right. So I think that's sort of the mindset of this group. And I think it does set them up for the potential mistake in 2024, which is just not being Volckerish, just not being as aggressive as maybe they need to be. And I think there could be a political aspect of that, but I want to be very careful about how I talk about that. It's just that if you think about it, normally a Fed chair appointed by a Republican, if he acted like Volcker, he would have this confidence that even if there's a recession and the political party changes, well, guess what? Republicans come back into office in this case, they should reappoint him, right? But I don't think that necessarily holds with President Trump. Powell might not be confident at all that Trump, who really went after him in his first term, would reappoint him. So Powell may not have the same parachute that maybe Greenspan had in the late 90s. And so I think that's something to think about as well. But again, the paradigm is, to not fixate on personalities, the paradigm is one in which the US as a state has been moved by this fear of secular stagnation and deflation. And that created this enormous policy consensus in the 2010s, time to stimulate, time to reflate, even to the point of entertaining modern monetary theory and these things. Now they've generated the inflation, and you start to see the public reacting to inflation, and you start to see this political constraint come back. Well, let's not inflate too much. But I'm not sure that it's created a new elite consensus that is as terrified of inflation as maybe some people on the street are. And even the people on the street, like we talked about, looking at surveys, are not really panicking yet. So I guess what I'm saying is that there's room for the Fed to make a mistake here. I think there's quite a bit of room for that, and I think that's true even aside from the election, the 2024 election. But to whatever extent the 2024 election matters, the Fed might be tiptoeing a little bit too much and not being as having as stiff an upper lip as they should.
Yeah, I mean, I think about it this way, right? Because if you're right with the deflationary environment, they're very concerned about that. As Japan is a great example. It took them what 35 years to get back to where they started from the stock market standpoint. That's a crazy bear market. Yeah. And most people don't even think about that. But they still got their problems for sure. But it kind of brings up the fact of, well, we have the market is close to all-time highs at the moment. I don't know where it'll be where this goes live, but at the moment it's close to all-time highs, and we're in early December of 23, and yet we still have interest rates at 5.5%, and we have inflation that's declining. Although, you could argue whether that's accurate or not. I'm not going to have that argument, but basically you have it as declining, and that doesn't even include real estate dropping. Like, real estate is still stagnant, which to me is still mind-boggling. But you've got all these factors. So if the Fed, if we start to see serious deflation, that's one hand, and the other hand is inflation. Well, I mean, are they going to start chasing inflation around, dropping rates and raising it, and doing the spikes that we saw in the 70s just to chase it? I mean, it's an interesting question. I don't know. Like, I think prior to this, it was pretty obvious what they were going to do. Now it just seems like it's not so obvious if you have the specter of high inflation, which, because of the reshoring and what have you, inflation has a higher maybe median now. We're not. I don't know that we'll see the lower rates for long. So I don't know. What are your thoughts?
Well, we looked back historically to see hikes and cuts and how they interact with the presidential election cycle, and it is really clear that the Fed does not prefer to hike rates during election years. That's just very clear from the data. If it's a presidential election year, then they're considerably more likely to do cuts. And that's especially true if it's a closed election, meaning there's a sitting president who's running rather than just sort of an open competition. And that's where you see that in closed elections, the Fed has basically, they've hiked 25 times. In closed elections, they've hiked 17 times. They've cut 25 times. They've hiked 17 times in closed elections. The other thing is that when the Fed funds rate is above nominal GDP, that's also an environment for cuts. So even if you don't buy the stuff I was saying earlier about sort of the character of the FOMC being dovish, we still know that they feel like rates are restrictive and that they don't like to interfere with elections. And also, they're even further than that. If this were not a debate at all, like if the Fed were entirely independent, they know what they need to do to kill inflation. They just hike it until they kill it, and it would cause a recession and inflation would come down. But we all sort of deep down know that that's not what's going on right now. We know that there is a pivot or an attempt to pivot, and all these attempts at pivoting sort of reveal this preference to not do the aggressive hike until you're sure the problem is over. So we're not seeing shock and awe here. We're sort of seeing 2 steps forward, 1 step back. And in 2024, it might in fact be 2 steps back, 1 step forward.
Yeah, it's interesting because I think pretty much for the last 2 years, the market has totally disregarded what the Fed has said, right? They said in 2022, we're going to start raising rates. And January, it wasn't until January 3rd that the market started to react, right? Everyone knew 6 months prior to that it was going to happen. And yet the markets didn't react in 2021, right? It was only until 22 when it started to react. And pretty much the whole time that they were raising, the market the whole time was like, up, they're just going to cut rates in the next 6 months. 6 months they're going to cut rates over and over again for like the last 2 years. They're going to cut rates in 6 months, and we're still at that place. Hey, no, the Fed says it's going to be the same until the end of 2024, and the market's like, nope, nope, you're going to lower them in the next few meetings, and there's this complete disconnect from the market and what the market's saying. And where I'm going with this is the market has been consistently wrong for the last few years. In my opinion, it's because I think they're using a model of the old paradigm, which was prior to 2022, right? The paradigm was lower rates and print money. Hey, we have a problem, lower rates and print money. Simple. And it feels like we're in a new paradigm and the market hasn't caught up yet. So I guess my question to you is, I see this as a paradigm shift, and I think a lot of people do, but they don't really get it because we've been in one so long for this other period. In your experience, when you've looked back and seen other shifts or other paradigm shifts, whether it's from like 1980, 81 until pretty much 2021, those big shift periods, like what have you seen kind of like happens? And also, how long does it take to really for the markets to really recognize this? Because it feels like it's taking so long for the markets to wake up.
Yeah. Yeah, I think what happened in the early 80s is that well, and we can, we can sort of look at different cycles, but like let's just take the early 80s. What convinced the shrewdest investors, the ones who were the most forward looking, they became convinced that inflation had been defeated when the Fed was willing to inflict a recession and really wring it out. And the converse of that is, how do you know that inflation is really out of the box? Well, that's an environment where you see that the Fed hesitates to create a recession, and then a new wave of inflation begins on this recognition across all markets that that there's a lack of discipline. So, in other words, if we get the capitulation and the soft landing, at that very moment, that's when I think the forward-looking investors will draw the conclusion that inflation has not been defeated. And so I think the other element to bring into here is that external factors always have an enormous influence, global factors. So there's this endless conversation that we're all having about sort of the Fed and the market, but it's sort of implicitly about the Fed and the S&P, but the truth is that if we look abroad, we can see a different environment today than we've seen before. So, for example, China was a major factor behind those positive supply surprises in the 80s, which were also bringing inflation down. It wasn't all just Volcker. And now we have China actually slowing down and introducing supply constraints. The wage has gone up for the Chinese worker, and there's a trade war. So when I look at the global factors, what I see is a slowing and very troubled Chinese economy. And this is weighing on global growth. It's sort of helping to push Europe into a recession. And this is the dynamic that very well could prove decisive, meaning that the market keeps looking at the Fed for direction, the Fed keeps looking at inflation for direction, and China's telling us where inflation is ultimately going to go. And what that means is global slowdown first, and then later a second wave of inflation.
So you bring up an important topic, which is China. So what are your? I mean, there's a lot going on with China right now, both with their pairing with Russia, with Ukraine, and also with their potential conflict in Taiwan. And I mean, they're kind of, we're still the center of gravity in the world, but they're taking a lot of the gravity themselves. So how is this? How do you see this playing out with China? Just knowing like how they think about things, and how do you see this kind of moving forward globally?
Well, the first thing is that the Communist Party has really extensively reconsolidated power. So, excuse me, there was this phase in which the United States was attempting to engage China's economy because we thought that it would liberalize their political system. But during that time period, and this is, the 1990s and especially the 2000s, but during that time period also, China really did develop a parallel system where you had the Communist Party on one hand, but then you had the state bureaucracy on the other hand, the state council. And the state council was made up of these technocrats who were really sort of benefiting from globalization and from engagement with the United States. So I think the sort of nefarious American plan was, well, eventually we're going to have a split in the Communist Party because the state bureaucracy will represent a liberalized and like an economically liberal version of the Communist Party. And then the Communist Party will actually have competition, you know. But that's not what occurred. What occurred was the Great Recession, and then China, the Communist Party had a massive reaction, and they seized control of the state council. They seized control of all the guns, the People's Armed Police and the ministries of intelligence and security and the People's Liberation Army. And the PLA was always sort of an outlet for the Communist Party anyway. But you've seen all the ranks reshuffled. You've seen a huge corruption purge, to get the right people who are basically Xi Jinping's acolytes. So the whole system reacted 10 years ago and has been reacting for 10 years to centralize power in the Communist Party, centralize power in Beijing and the central government. And this then reverses the notion that China is led by technocrats who want globalization. It reverses the notion that China wants innovation, where each province can be a laboratory and households and businesses can experiment. It sort of reverses all that decentralization that created innovation, and it pulls it back in toward a centralist, statist, and ultimately really a security model. Not entirely dissimilar from what happened in Russia under Vladimir Putin. And it's just not good for the economy. It's not good for productivity. It's not good for animal spirits. It's not good for entrepreneurs. And we've seen this borne out for several years now in the data. So that's why I say that I think we get this China slowdown, and that ends up being the decisive factor in this cycle, global growth slowing down. And that's sort of where I was coming from in that earlier part. But then in terms of the longer term implications, now China becomes unstable because they have a slowing economy. The Communist Party no longer is providing so much income growth that the households are pacified. Social unrest emerges. And China starts to put pressure. First, they put pressure on neighboring countries like Taiwan, or countries, neighboring entities like Taiwan, or neighboring countries like Korea. And they're basically saying, you cannot cut us off from technology. You can't play this American game because we need the technology. It's our only hope to grow productivity and expand in this circumstance that we ourselves have gotten in. And so that's a proxy conflict with the US and its allies who are going to be under pressure from China. And if it ever gets really bad, if you end up with a full-blown financial crisis and debt deflation trap in China, a balance sheet recession, if those things happen, then China's foreign policy could become quite aggressive. And there's a whole debate on whether China would become more inward oriented or more outward oriented. But typically the scholars who say that they'll be inward oriented, they're looking back at history where, China doesn't like to invade people or something. But a lot of those historical analogies are not relevant today. Today, the evidence is that for 10 years, as the economy slows, China gets more aggressive externally. And so I think we have to be prepared for the US and China to continue to disengage and for there to be effectively a Cold War because of this, this unfortunate development in their own economy, as well as the fact that the US is blaming them for our own problems.
So I'm curious when you say, because I'm familiar with the inward versus outward, focus with them, where they've historically not been confrontational with other countries. So I'm curious why you think that would change, because it's not in their nature, right? And I think if I look at the Chinese, if I look at China, they're probably one of the smartest strategically as a country, as a nation, out there. They're looking 50, 100 years out, and they're strategically making steps in that direction. And I give them a lot of credit in that way. But to me, it seems like they're not dumb enough to want to start a war, because they know that that doesn't serve them. And there are many other ways they could pursue their interests. So why do you think they would be more aggressive externally? And what do you think that looks like, more importantly?
Yeah, right. So specifically, I do agree with you. I mean, and certainly, this is not a knock on the Chinese people. I mean, these are this is a very impressive culture for thousands of years, and I agree on the strategic savvy. But what we're talking about here are humans, though. So when we talk about nature, what's in one country's nature or in another, the nature is human nature, and human nature is that if there's conditions in which it's a state is centralized or organized at home, meaning they're not having civil war or chaos at home, they're organized, and they feel that they can benefit and expand their interests outward, then they will. And that applies for every country. So we had hundreds of years of German disorganization and chaos, but the result was a massive centralization in the 19th century and 20th century that resulted in world wars. So so it didn't do any good to say, because people used to say this, really. People for hundreds of years, they said, well, the Germans will never cooperate. The Prussians don't get along with the Bavarians, and the Austrians don't get along with the Hanoverians, and Germany will never unite. Germany will never be a major actor in the world. So we can't assume that the China that we have in the 21st century is the same China that would kind of retreat into a turtle shell when it faced problems. That can be true if they are internally unstable to the point that the Communist Party's risking the loss of control. That would be an environment where they could retreat. So I agree with that. But if the Communist Party has full control at home and they're not splitting at home, then they may at some point believe that calculated risks abroad would be worth taking. And I want to be specific, because what I'm talking about there is breaking through the cordon of technology that the US is trying to create. If the US succeeds in creating a watertight technology containment, then China's economy will slump. Their future will contract, and they will get sort of foisted into a low growth environment, and they can't really handle that. So these calculated risks abroad may not be invasions. If your goal, for example, is to maintain access to Taiwanese sophisticated semiconductors, well, the last thing you actually want to do is go and annihilate Taiwan and bomb it into a parking lot, because then you don't get the semiconductors. So these are different policies, but they might be outward directed. And then, of course, there is also the other problem that I said, well, in terms of history, it's not entirely true that China's never been aggressive. So first of all, they've invaded Vietnam many times. They've tried 9 times, but I think they've only been successful 3 times over the past 2,000 years. Also, the Koreas have always been an avenue of influence. But remember, of course, that what China has done is had conflicts with neighboring peoples, whether it be Mongolia or Xinjiang or Tibet, or even southern China. A long part of the history is whether northern China can unite southern China. Well, in today's context, how do we translate that? Well, the point is that they've fully consolidated power over Manchuria and Inner Mongolia and Xinjiang and Tibet and Hong Kong. So there's only one outlier, which is Taiwan. And it's a very clear pattern. They are ultimately looking to assimilate and subjugate and control the island. So that's a matter of time and a matter of tactics. But in the last resort, they are clearly willing to use military power, and that could be triggered by the Americans providing Taiwan with too powerful of weapons, or it could be triggered by China's own policymaking becoming imbalanced. And for every person out there saying, well, China doesn't like to invade other countries, remember that China doesn't consider Taiwan another country. So that might apply to Vietnam if we're lucky, but it doesn't apply to Taiwan. So anyway, that's sort of a long, winding answer. But I guess my point is that if China's unified at home and they have the capability and they believe that they can benefit from a military conflict, then they'll go for it. And that's how wars happen, and that's how other states operate as well. And similarly, if China's collapsing at home and the Communist Party thinks they're literally going to be thrown out of power, they could also resort to some drastic foreign crusade to try to unify the nation. Those are both viable options over a 20-year period.
Yeah, I think that's fair. I think it's definitely a fair assessment. I want to ask one more question before we wrap it up in the interest of time. Is you had mentioned technology. So how are technological advances going to impact the global economy or even domestically?
Well, the main thing we've seen, first of all, is that the U.S. continues to have leadership in these areas. So that was clear with the COVID vaccines. That was clear with the weaponry used in Ukraine. I mean, even though Ukraine is, still had a fifth of their territory taken, they put up a much better fight than most people expected, and it was largely because of American weapons. And of course, the Americans and others didn't put troops on the ground. Also, with AI, we see that the Americans have been the leading actor. So one thing is that U.S. technological innovation continues, and this is one reason why some people don't fret too much about elections and political risk, because they say, well, look, the grinding on of industrial advancement and technology, that continues regardless. It's also a reason why some people are not too worried about inflation. If the inflation narratives are driven by politics, and yet artificial intelligence is making huge strides that could make more efficient economies, then maybe we don't have to worry about as much inflation either. So those are clear points that are raised. But what I would highlight is a couple of things. First of all, I don't know that AI or the big advances technologically will come in time for this cycle. So, and I sort of made that point earlier, but I'm just saying you can agree with both views. You can agree that we'll have a big technological boom and productivity boom, and it'll reduce inflation. But it doesn't necessarily reduce inflation next year or the year after that in a dramatic way. Now, then the other side of it is long term. It's not clear to me that the U.S. leadership will be supplanted by China. And the reason is not because of American restrictions, because I think China can circumvent American restrictions. And I think China will make some big breakthroughs. That we will have a competition here. We will have a technology race and an AI race and a space race and these things. It's just that this change in China's policy that we're talking about, their domestic politics, erosion of governance, has really, and the centralization of power, this has really reduced the ability of innovation to operate. So state-oriented innovation can achieve a lot of aims that will be impressive, and they're ultimately harnessed toward military capability. And that same process causes all of China's neighbors to distance themselves with China, form alliances with the U.S., join the U.S. in coalitions to constrain China's trade. And all of these things end up ramifying back negatively on China's manufacturing industry and their households, which start to deal with unemployment. So I don't think it ends up working where they can leapfrog in quite the way that they want to, because the world will react to that process.
Yeah, no, I tend to agree. They're definitely in a pickle there. So as we kind of wrap it up here, any final thoughts or any areas that you think we didn't touch on, you think are important as we go into the the 2024 election and all the stuff going on?
Yeah, I would just underscore that, I think it's well known in the investment community that stocks, especially in the US, they tend to go up, right? So there's a tendency to sort of dismiss geopolitical analysis. But I would just underscore that we're in a very particular juncture. We're in a critical juncture that could involve US Russia conflict or US China conflict. So if we see stabilization incrementally in those relationships, then that can stabilize the world, and then we're off to the races in terms of multi-year productivity growth, But if things continue to deteriorate, we can't ignore that forever. And that is not only about Ukraine, that's about Russia's general outward aggression, but it also has to do with the US China things we talked about. And finally, with regard to the Middle East, again, if there's no deal on the nuclear program, then that will undermine regional stability, which will create energy shocks. So that's sort of the way that I would bring it all together.
Okay, awesome. Well, Matt, I really appreciate you coming on the show and sharing your wisdom with us. We'll definitely be back in the future. I think as year progresses next year, probably a lot more is going to change in many different ways. Would love to get your insight as we kind of try to navigate through these difficult times. So thank you for coming on the show and sharing with us today.
Yeah, thanks, Kirk. Yeah, absolutely.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right, well, that was a great interview with Matt. Really appreciate him coming on the show. Awesome stuff there with the global macro research. Love conversations like that. Can't get enough of them because the macro stuff really drives the world, and that eventually filters down to the stock market. Of course, everyone's got an opinion on that, but I don't really care about other people's opinions. I only care about my own. Anyway, we're starting the year off right here with a little comedy. So we're getting to the panel portion of the show. We have our very own Phil Weiss. Hey, Phil.
Hey, Kirk. Happy New Year. Good to see you today.
Happy New Year to you too. Glad to have you on the show. We also have our very own Tim Baker. Hey, Tim.
Hey, Kirk. Happy New Year as well.
Happy New Year. All right. Well, let's get started. So, Phil, what were some of your takeaways from the interview?
I thought it was a really interesting discussion about a lot of these macro issues and a lot of the disconnects. I mean, you talked about how the market doesn't always seem to be listening to what the Fed is saying these days as far as interest rates and things like that go. That's a big one. I'm always, as a former oil analyst, I'm always interested to hear when you start to talk about oil price shocks and what's going on with oil prices. So that was also something that was interesting to me as well.
Nice. Cool. So, yeah, I mean, Tim, we talked about a lot of stuff in the interview, but what's kind of top of mind for you this year when you're thinking about like macro issues?
Yeah, and Phil just mentioned his background as an oil analyst, and I used to be a fixed income analyst. So I take all of this, anything having to do with central banks around the world. And I know in the interview you talked a lot about globalization. I actually gave a presentation at a local library last night on COVID, inflation, the Federal Reserve, and recessions. Um, and all of that came into play towards the end. People started asking questions about yeah, it's the Federal Reserve, the Federal Reserve, the Federal Reserve. But we've got to change the world now. The political system that we have here in the U.S. Embarrassing or not, we can debate that some other time. But it's having a bigger and bigger impact on the financial markets. And he was asking if I thought that it had changed the nature of the financial markets, and I pointed out to him about a year and a half ago I did my own study on financial markets pre 2008 and financial markets pre Eurozone area. And it actually, if you look at those periods since then and before then, your Sharpe ratios have inverted. So prior to the Eurozone being created and post, prior to them, you were getting greater returns for a smaller unit of risk. And ever since then, you're getting the reverse of that. You're still getting positive returns, but you're taking on much more volatility, much more risk to do it. So I think all of that macro and non-financial market related stuff is starting to drive the financial markets more than fundamentals.
I don't know, Tim. I think the science is in. The science is solved. The debate is over. The Eurozone's a good thing. I mean, what are you talking about? Like the politicians told us it's a good thing for us, and we should be happy and smile about it. So
That's
why
right.
why and so some of the listeners don't really know what a Sharpe ratio is. So maybe you can kind of like evolve
Yeah,
that a little bit
sorry.
more.
It's basically so if you look at your 15-year return, you would look at the 15-year volatility of those returns. So how much did those returns change on a year? I mean, ideally you'd go monthly, because the more data points you have, the more robust the data is. But what was the volatility of those returns over that period? So if you have a return of 10% and you had 10% volatility of those returns, meaning they changed on average 10% over time, then you would have a Sharpe ratio of one, which is good. I mean, I think that's what most people strive for, is a Sharpe ratio of one. And what you've seen since the periods that I discussed is you're getting a 10% return, but taking 16% volatility to get it. So basically, I guess to answer your question, it's your volatility of your returns. You're still getting the same return, but you're taking a lot more risk to do it. You're taking a lot more volatility. And I don't want to totally sidebar the conversation, but to me, risk is a much different thing than I think the way most people think about it. Most people think of risk as the volatility of your return, and my thought is always, who cares about the volatility of your return as long as you get it over time? Risk to me is more like risk of loss of capital, and you can diversify risk, right? Your risk of loss of capital is much higher if you buy Bitcoin than if you buy the S&P 500. You can diversify risk of loss of capital away. Risk of volatility, I think, to what we're talking about right now, I think it's harder to diversify that away because just markets themselves have become more volatile to give you the return that you've been getting.
Yeah, I agree and appreciate the description. I think that's helpful for the listeners. So one point that kind of I find fascinating, we talk about in the show a lot here, is that when it comes to risk and when it comes to correlations, things have changed in the last few years. And it's funny. I've only seen a handful of people point this out, and I'm shocked that more people haven't. But what we've seen in the last few years is you used to have an inverse correlation between stocks and bonds, and now they're they're correlated. So the diversification that people have just doesn't apply anymore. So if you think you're reducing risk by diversifying, you're fooling yourself. So Phil, what do you think about that? What do you think about that new dynamic?
It certainly makes it a lot harder for us as investors because historically we thought about, we have a portfolio and we have different, we diversified into different things, and we expect some things to go up and some things to go down. And that's where we get into correlation. Correlation kind of measures how things move relative to each other. If the correlation is 1, they move perfectly in sync. If it's -1, they move opposite. And we used to think that when we diversify, we're going to have some positive correlation and negative correlation, so that we're going to have some things that balance out. And it's gotten a lot harder to find that balance. And so many things move together. It used to be that they all moved apart. I mean, look at 2022 is a great example, right? We have bonds. Bonds are supposed to diversify. They're supposed to reduce your volatility. They're supposed to reduce your risk. And in 2022, bonds went down a lot. And so if you had your traditional portfolio, there was nowhere to hide because stocks went down, bonds went down, and everything moved in the same direction. So the correlations were all positive. There was nothing to offset unless you found other investments. So it's gotten a lot harder. I think that's the biggest thing to me. It's gotten a lot harder to diversify against risk because so many things are moving in similar ways.
Yeah, I mean, it's funny. You mentioned bonds going down a lot. The 30-year treasuries went down 55%.
Yeah, that's
I mean,
a lot.
up until October, I think the low was in October, but 55% is not chump
deal.
change. Yeah, it's kind of a big deal.
So my treasury bond that I thought was guaranteed and safe lost half of its money. Who cares?
Yeah, whatever. It's just it'll come back. In
Yeah,
30
it'll come back
years, it'll
someday.
come back.
In 30 years, I'll get the yield that I originally bought it at.
Well, let's kind of dive in because you brought up, Tim, Europe, and one of the areas we talked about in the interview was China. We didn't talk as much about Europe, but China and Europe. I mean, if you look at the charts for the last few years, I mean, China has definitely. I mean, Europe has been stagnating for a while, and people. I've been hearing the drums beating for like the last 10 years. Oh, it's Europe's time. It's a value play. It's gonna take off. And of course, you've been hearing the same thing about Japan for like the last 30 years as well. Japan's a value play. Maybe it still is, but and then you look at China, and China, you got the same problem, right? I mean, China. I'm just pulling it up here now as we look. It peaked out in 21, and it's pretty much gone. It's just kind of like a negative slope all the way down, and a lot of that had to do with their policy, with their public policy about investors, and basically became investor unfriendly. But they haven't been able to turn it around. So, what do you think things look like from a macro perspective from Asia as well as Europe? Like, where does that take you when you start thinking about investing there?
Yeah, I mean, so China to me is, I mean, we've always got emerging markets in the portfolio because it's a good diversifier. Those returns actually do tend to be, well, have relatively low correlation given beta or what you would have for just having stock exposure in general. But to me, the biggest risk with China has always been the headline risk. The, the fundamental risk is China's economy really growing as fast as they say it is? Who knows? We don't know, and we're never going to know. We have to believe the numbers that they report to us. What's of greater risk and of greater concern, and why we underweight emerging markets, which I think most people know China makes up close to half of the emerging markets world, is it's the headline risk, it's the X factor, it's we're banning your technology companies on our exchange, or the US is banning Chinese companies on our exchanges. There's always some kind of fighting going on between China and their own trade partners, right? So we talk a lot about, like, what if China just disappears? Well, then frankly the US disappears too. I think they're the number 2 or number 3 buyer of our treasury bonds. They're a massive trade partner, especially for our bigger technology companies. So we do want to have them in the portfolio to some extent, but they do inject a lot of risk and a lot of volatility into the portfolio because of those headlines. As far as Europe, it's similar in terms of their relationship with China. but in terms of owning them as a piece of our portfolio, we underweight them pretty dramatically as well. And this is going to sound like the least data-y thing I've ever said on this show, but they're just boring. Like there's just
That's a
no
technical
offense to
term.
you.
All you listeners, that's a technical term. If you don't understand, ask me
I hate
later.
to get all scientific here, but no offense to Europeans. I used to live in England. But it's we've talked about this before, Kirk. I think you and I had a one-on-one about this on one of my podcasts. Is when you look around the world, like where the great companies generally come from, we happen to live in, for all of our flaws, with our politics and our border arguments and whatever else it's going to be, we do have a very free and innovative economy. We encourage innovation, and so when you think about like the great performing stocks of all time, Apple, and Google and Facebook and all of these things that have just been dominating the market for the last 15 to 20 years, you look around the world and go, oh, yeah, they're all in the US. So and here we are again. I just had to confirm it. Year to date, I mean, we're only a week into the year, but sure enough, the US in a down market is holding up much better than non-US developed and emerging markets. And last year, obviously, the S&P 500 outpaced everything else. There was an interesting article that I put in my weekly email a couple of weeks ago saying nothing beat the S&P 500 in 2023. And I was like, hang on a second, I'm not sure that's
That's not
accurate.
true.
Ever heard of QQQM, which was up 54% last year? But the point of the article was great because it talked a lot about behavioral errors in for the average investor. But sorry, I digress. So China, global stocks, well, non-US stocks to us are good to have in the portfolio, because they can diversify things and smooth out returns. But our bias is always going to be towards the US because there's greater transparency, and transparency is always good.
Yeah, I agree. And I noticed you don't still live in England, so I'll let that speak for itself. But anyway,
Can't afford the taxes, but my education and my healthcare was free. So,
get your money's worth, huh?
yeah.
As a friend who lived over there, and I think they still have a COVID lockdown at the moment.
As soon as they can
Crazy over
serve a
there.
steak rare, I'll go back.
Yeah. As soon as the food's good, I'll go there.
Yeah.
So, but anyway, so Phil, what about you? I mean, we did look at like kind of global macro stuff. Like 2024 is going to be a crazy year. Lots going on. We got the presidential election. I mean, where do you think people should be looking or thinking about going into this year?
I'll share what Tim's sentiments on. While I do have allocations to emerging markets, I'll tell you that my emerging market allocation, I really don't have very much at all in China. I try to exclude China. I was reading a story earlier today. It was something about BYD, which is an electric car manufacturer, which, if you look at it all in, actually has greater sales than Tesla does. But the US restricts sales, Europe restricts sales. So their opportunity for growth isn't nearly as great as you'd think, even in that position, because they have restrictions on being able to sell in two of the biggest car markets in the world. So there's a lot of reasons. There's a lot of things you've heard about companies where if you don't agree with the political view in China, you might be gone. You might not be in charge. So, and you don't own, like if you own shares of Alibaba, you don't really own shares of Alibaba the way you do in the US. You own rights. And so those could be taken away from you. So there's more risk. So I generally try to avoid not emerging. I have emerging market allocation, but I leave China out at this point. My European allocation is there, but it's smaller than most people would say it should be, because as Tim said, the growth and innovation, those companies are all in the US.
Yeah.
I mean, look at all Tim mentioned QQQM. I mean, it's not all technology, but it's a lot of technology. And just for those that don't know, QQQM, you hear about QQQ all the time. That's like the NASDAQ 100. QQQM is the exact same thing, except the expense ratio is 0.05% lower. So if you're choosing, buy QQQM because you're going to pay a little bit less to get the same product. But if you look at that, I mean, it's all the vast majority of the fastest growing companies in the world are going to be in that index.
Yeah, it's interesting. I mean, you look at last year, and last year was crazy. And I always like to point this out because people are like, why didn't we make 100% returns last year? Everything else was up a lot. I mean, the Magnificent Seven was up like 150% or some crazy number for the year. And you know, the NASDAQ was up a lot, and the S&P, it's like, well, if you look at the equal weighted S&P, it actually wasn't up that much. I mean, it was up. It was up maybe, I think it started at like right around 140 and ended up the year around wherever it was. It was somewhere around like 157. So whatever that comes out to. But it's a far cry from the S&P. It was actually negative in October for the year, you know, the equal weight. Then you look at the S&P and it was up a lot. But I point it out because it's like it's all based on where it ends the year, right? That's the starting point. And the next year has to grow from there. But if you look in the last 3 years, the market's gone sideways. We just happen to end the year at the high end of the range, right? And it could go higher. I don't know the future. Maybe it goes higher. Maybe it does great. But at the moment, it's still in the range. And so I find it interesting because, like, I look at Europe the same way. Europe is in a range, you know, and every time you look, is like, is it the low end of the range or the high end of the range? Well, right now, I think it's, where is it? The high end of the range, I think, depending on which index you're looking at. But if you look at the FEZ, the Eurostock 50, you know, it's kind of like the higher end of the range, whereas October of 22 is at the lower end of the range. It's like, okay, like, so it just kind of brings up, you know, this aspect of, you know, look at the Warren Buffett approach, like you buy and hold for 20 years and you see what happens. And it's hard to do that with some indexes. You know, you're allocating a portfolio, like you said, Tim, it's boring. We don't even have exposure to certain countries or areas like Europe or, you know, China. There's certain areas we just don't have exposure. Like, what's the point, right? I mean, if we go back to history, you look back at the emerging markets for decades, for 40 plus years, they trended strongly. If the trend was positive, they'd be up like 80, 100%. If the trend was negative, they'd be down 80%. Like, it was just this, it was like investing in crypto decades ago, right? You just get these huge swings. And if you were on the right side of it, you made lots of money. If you're on the wrong side, you lost a ton. So it just brings up this question of, like, why are we even diversifying? Like, what's the point anymore of diversification if it doesn't work? But the whole system is buying into the idea that we need to diversify. So how can people go about this? Because in this country, for the last, I don't know how many years, I have to count them, the US has been like the beacon of like, you know, any sort of stock market index has really been the place to be. It's where people are putting their money. And probably rightfully so in some ways, but also, why is it so one-sided? Why is it only us and the rest of the world's not participating? So it's just open questions. I mean, I don't know. What do you think, Tim, going forward? I mean, outside of Europe being boring and China being off limits, which we won't touch
Yeah,
China with
so
10 foot.
everything you just talked about is a lot of what I was addressing to the audience last night, what audience we could get here with 75 inches of rain in Connecticut last night. But um, you know, the whole idea of a couple of things, you talked about correlation. One of the things that's important to remember, because the purpose of the event was, you know, we went through all this inflation and the Federal Reserve jacked up interest rates after a 2 year lag, right? Let's not forget how late the Fed was to the party in raising interest rates. And so they were playing catch up, and that crushed markets in 2022. And actually, one of the folks in the audience made sort of emphasized this point for me, which is, I think it's I think it's difficult to take a period like 2020 to now and extrapolate anything out of it, because we're in very much the hangover of what was essentially a man-made event. I don't want to debate whether or not we should have gone into lockdowns. There was obviously a pandemic, people were dying. I'm not going to make a judgment on whether or not we should have gone into global lockdowns, but we did. And that caused demand to go away immediately. And that causes supply to go away, because if nobody's buying what I'm selling, then I'm not going to make it anymore. And then boom, we get a vaccine and the economies reopen and all the demand comes back and there's no supply. And then all the suppliers are trying to catch up. And then you have the supply chain logistics where you have uh, 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 tanks on cargo boats being thrown into people's yards in Los Angeles. And it just was, it just got, it got bad. But if you go back to prior to that, and even in the beginning of COVID, diversification did work. You go back to 2008 in the market crash, bonds did well when stocks did poorly. In March of 2023, bonds that 5 week crash when the S&P 500 was down 33% or whatever it was. The U.S. ag, I believe it was the ag. It might have been the 10-year. I'd have to go back to the charts that I made, but was actually up 3% during that period. So I think 2022, having stocks tank and bonds tank at the same time, I think that's a natural offshoot of the Federal Reserve trying to play catch up with a very man-made financial crisis. And there's been a lot of commentary. I'm like you, Kirk. I have no interest in trying to predict the future. I've got a 50% chance of being wrong. But there's a lot of folks talking about 2024, assuming we don't get another pandemic or some other black swan that it makes everybody want to go back to bed every day, is that we're going to now get back to some level of normalcy. If the Federal Reserve has raised interest rates enough, which they keep saying they have, that's why the market rallied on, what's today, Wednesday? That's why the market rallied on Monday. There was a Federal Reserve governor comment about, we don't need to raise rates anymore. We do think inflation will come back with rates where they are. But I do think if that happens and we do get back to this period of normalcy and the Federal Reserve starts to lower interest rates, earnings remain strong, I do think that diversification effect will still matter going forward. I just think we've been in this bubble from 2020 to 2023 that was kind of a manufactured economic environment where a lot of free economy was not at play. So I do think diversification can still help going forward. It's just the last 4 or 5 years sort of skew the longer term numbers.
Yeah, I think that's fair. Phil, what about you? Thoughts on that? And I also want to talk about the election too, not the politics of it, because I don't want this to devolve into barbarism. But I think if we can, bring that in, because that's obviously a big factor here, and we can't discount. If anything, we can handicap it and think through how it's going to play out.
Sure. I mean, I do think that the last 4 years have been a very unusual period, right? And it is true. It's all around the time period you look at. It's like last year, as we said, was a good year for the market. 22 wasn't. If you look over the last 3 years, it's a much different thing than if you look at any one independently. But what's interesting to me is I have up here a chart that shows asset classes over the last 10 years. And if I look over the last 10 years, the top 4 categories are US large caps, US mid caps, US small caps, and US REITs, right? So we've got a 10-year period that US stocks overall have dominated. I mean, there's years in there, like 2022 is a great example where large caps were third from the bottom in terms of returns. But we look over that whole 10-year period, diversification hasn't provided as much value because it's all been so much of the return that we've gotten from the market. It's come from the different classes of US stocks. We've had some unusual events, the pandemic and the reaction to it that Tim went through very nicely. That has a big impact on it. We do hope that we get back to some periods of normalcy, because if we go back in time, it's been a while, but there were times when international stocks did outperform US stocks. Whether or not that's going to happen again, we don't know. But one of the points of diversification is to try to minimize your risk. And so I still think that there's diversification matters. It's just, it may not matter as much. And so that the allocations within a portfolio may be a little bit different than they were historically, but we can't escape the fact that things could change, right? I mean, you go back to the period when Japan was the best market in the world, right? We've had times where the US has been the best. We've had time when Europe's been the best. I don't try to predict the future. I always tell people 2 things. My crystal ball, it's both cracked and cloudy. So I can't tell you what's going to happen next. So if I can't tell you what's going to happen next, I'd rather have a diversified portfolio, however I want to diversify it, because to me, when I'm working with a client, the last thing I want to do is tell them that we took too much risk in your portfolio and you can't live the life that you want to live. That's like the worst news I could ever deliver to a client. So I'd much rather be more conservative. It means I'm going to get lower returns on the upside, but I'm also, if I've done it right, going to get lower losses on the downside and reduce some of that volatility and take out some of that risk and hopefully allow them to live their most fulfilled life. I mean, that's really my goal as an advisor.
Yeah, no, that's a great thing, Phil. I love that. And I think, I think more people need to be mindful of the fact that, you can't tell the future, but as we get close to wrapping it up here for the show, I wanted to, get some final thoughts from each of you, maybe touch on the elections a little bit, because I think a lot of people are going into this thinking the world's going to end. I was actually listening to another podcast last night. It was really good. And the guy was talking about the election, and, much like me, I try not to talk politics in the show just because it's like trying to argue what the weather is going to be like tomorrow. Like, I don't know, and nor is it going to impact what I care. The weather's not going to change just because I care about it. So, and the point they made was like, look, everyone thinks Trump is an existential threat, yet he was president for 4 years and nothing happened. I mean, you could argue whether something bad happened or not. But I think the point that I want to make that was interesting was that we overuse certain words and we exaggerate certain words. Like existential threat means that the world's going to end immediately, right? Like this thing is going to implode and the whole world's going to end. That's not really the truth. Like people are getting fired up about that. You might not like his policies, you might not like him. Totally understand, right? Like he's not a very likable guy in so many levels. But as an existential threat, like I'd argue probably not. We've seen 4 years of it not, the world not ending or even a war starting, right? But yet we have 2 wars starting now. So it's kind of like, what is the rationale behind it? And are people thinking about it? Are they really thinking through the scenario? And there's not a defense of Trump. It's more of a defense of rational thinking. And the reason I bring it up is, and this is the example they use. They said, look, we always go back to this example of history. Like if you could go back in history and like strangle Hitler in his crib, would you do it? Well, yeah, you'd save millions of lives, right? You would, you would argue that would be worth the price of whatever it was to make that happen, right? You could argue, well, would you kill one person to save a million? Well, probably, right? You get into these philosophical rationalizations, and like, well, if Trump's an existential threat, didn't you do anything possible to make sure the world didn't end? Well, philosophically, that makes sense, right? Like, of course you would. If you thought the world was going to end because of something, you would do whatever it took to do it, even if it was illegal, right? And some people took that route. They took illegal routes to make sure that he didn't do whatever he needed to do. That's not the argument. The argument, is it an existential threat? Well, at this point, I would say I wouldn't use that word. You could say dangerous, but I would say current president's dangerous too, because we're in 2 wars. So where do you draw the line? And my point is that I think we've created a lot of extremism in our language in the last, 8 years that wasn't necessarily there before. And in some ways, it gets people to stop thinking rationally, right? And, I don't like either one of them, but do I think that they're an existential threat? Absolutely not, right? They're just people you don't agree with their policies. Neither one of them's Hitler, but they're being called Hitler, right? Like you see all this language and it's like, we're getting into election season. And what I find is I love when you're, when you have like, I don't know, is it 10 different competitors for Republican ticket? So you got 10 different competitors. Everyone's idealistic. They're like, oh, it'd be cool if this person won. It'd be cool if this person won. I love this time of year because people are actually having interesting conversations. Like, oh, what if Vivek won? What if Nikki Haley won? What if this won? What if this? And it's just like, everyone's got these idealistic visions of like, even though this person has no shot in hell of winning, you got a 1%, like Chris Christie's got like a 1% chance of winning, I think, or something like that. It's like, but he's an interesting guy. Like what happened to him? Like there was a time where people were saying he should run for president, and now he's like got a 1% chance of winning. What happened to him, right? Like, and it's like, but you have all these interesting conversations you can't have when you're debating against, Republican versus Democrat. But right now you can have these. And it doesn't happen on the Democratic side because I don't know if anybody's running. I guess one person's running against Biden. I'm not sure if others will jump in, but it's not as interesting when you have an incumbent. But when you have the challenger up, it's really interesting. The conversations are interesting. But once that's decided, once the die is cast, and I think I don't think anybody's arguing that Trump's going to get the Republican ticket, because I think it's just the spread's too wide. Nikki Haley's got like a 5 or 10% chance of getting it based on current numbers. So if it's basically another Trump versus Biden, well, now it gets a lot less interesting. Now no one's talking about it. It's just like, oh, people get polarized, and then everything shuts down. Logic shuts down. Thinking shuts down. And I'm bringing this up as more of a lesson for the listeners. You can use this as this crazy time, this crazy year. Once every 4 years, things get crazy. This year is just crazy as 4 years ago. But I think it's a good example of what happens when your brain shuts down. What happens when you stop thinking? This happens in investing too, right? In March of 2020, your brain shut down because you're freaking out because the world ended and you're shutting your house and you couldn't do anything. You weren't getting paid. All these bad things were happening at once and your brain just shuts down. You stop thinking rationally. Great time to buy. There were a lot of great opportunities. I wish we had been more aggressive, but the whole world was shut down. It's hard to argue that this is going to be the bottom when businesses aren't operating. But there were some good opportunities there that people just dismissed because, oh, well, it's, my brain isn't working. I'm just going to go turtle up and not think. So I think it's more of a lesson in human psychology that people should keep in mind during this year and forget what the outcome is. I'm not going to discuss that. I can talk about odds over the next, 8 months. But I think in terms of thinking, no matter who you believe in, which party you buy into, whether you buy into any of them, this is a time to mindfully take a step back and start thinking rationally and saying, the media source I'm listening to is firing me up. Maybe I should stop listening to it. Like, is it news or is it just propaganda? Or is it just a political ad, right? Because there's no information anymore. Like, we have all the information we need. It's just opinions. And do we really need to hear someone else's opinion, or can we formulate our own? I would argue that we should always formulate our own first and then listen to others to decide whether our opinion is right based on who you're listening to, right? Like, if I come up with an opinion and Jeff Druckenmiller comes out and says something completely opposite, I'm going to be like, well, maybe I should rethink my position, right? Not to say that I should change it because of what he said, but just, where am I wrong, right? Where is my thinking incorrect that he came up with the opposite opinion than me? Maybe I'm thinking about the problem wrong. Maybe I missed some data. Maybe this, maybe that. But at least I can rethink and decide, all right, did I do really good research, or did I just read a news article for 5 seconds and decide I'm going to buy that thing because the news article told me? I remember a time back in, maybe it was 2010, I think it was around the Euro crisis, the first Euro crisis, the number one, where George Soros came out and said, I'm going to short the Euro. And on a whim, I was like, yeah, whatever. I'll buy the short Euro shares. I'll buy whatever, a few $100 worth and just see where it goes. Of course, that was the bottom, and then Euro shot up from there, right? And of course, I did it as an experiment because I know that's, that stuff happens. I'm like, go figure, right? That's what happened. And of course, it went the other way. Well, I listened to the news, and the news told me the exact opposite thing to do because George Soros decided, I'm going to go out in the news, tell everybody my opinion, people are going to do it, and I'm going to have people to sell into, right? This is what happens. The big wigs come out and they tell you something, then you go, and they're trying to liquidate a position, but they can't because there's not enough volume. So they tell the world something and they bring more volume so we can get out of this position. Happens all the time. That's why you never listen to the news, right? It's basically propaganda from people that are trying to manage portfolios in large part. They're not all that, but there's a lot of that, and it just, no one's really telling you their best stuff because why would they? So, all right, as we wrap it up here, Phil, final thoughts from you, and where can people find more about you?
So one of the things that I thought of as you were talking, Kirk, is the idea of confirmation bias. It's so prevalent everywhere we look today. We want to find people that agree with us. It makes us more comfortable, makes us feel better about our decisions. But when we do that, we don't explore the other side. It's important to understand both sides and make our own decisions and make sure, what is it that I might be missing? Like, I love when I'm doing research to find somebody that takes the opposite side, because that helps me understand, did I miss something? I might not be right, or I might not have considered everything. And I want to make sure that I take everything into consideration. And that applies in a lot of these situations. As far as the only comment I'll make about the election in general is the idea that if you look over the data, the difference in how the market and the economy performs when we have Republicans as president and Democrats, it's not that it's not that big a difference. It doesn't really make that much a difference in the overall big picture. So you'll hear a lot of stuff in the media talking about that, but I don't know that it really matters that much. At least historically, it hasn't.
Yeah. So where can people find more about you, Phil?
So I work with women experiencing big life transitions. My job is to help empower those women facing new beginnings, with the financial knowledge and tools they need to make self-assured decisions. My firm is Apprise Wealth Management. You can download my free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook. And you can also sign up for my blog. And thanks for having me today, Kirk.
Thanks for coming on, Phil. And Tim, final thoughts from you.
Yeah, I loved everything you were saying there at the end, but the one that's nearest and dearest to my heart is don't formulate opinions based on what somebody else thinks. My son was a big Trump fan, and started arguing with other people on Instagram, and I'm like, hey man, don't start becoming a quote unquote Trumper. Like, if you like Trump, that's great because you agree with things that he's doing. But you should always be thinking critically about what even your most favorite person is doing. And I'll never forget sort of a pivotal moment in my life when I was trading, or excuse me, actually, I was doing corporate bond research on Citigroup's bond trading desk in the early 2000s. And we had a buy rating on WorldCom bonds, right? Unfortunately, accounting scandals are difficult to know until you find out about the accounting scandal. When somebody tells you they're reporting GAAP earnings, even the auditors are getting fooled because they're qualifying as GAAP earnings. And so this advisor started yelling at me about, you guys had a buy rating on these bonds, and now you're putting a hold on them. And I was talking to my boss about it, and he said, yeah, smart people, when they get new data, they change their minds, right? It's the people that get new data and don't change their minds that tend to ruffle the feathers the most. And back to your point about the government, it would be awesome if everybody could just remember our whole principle of checks and balances. Nobody's going to destroy this country because no one person can totally change everything. But I also appreciate you having me on. My whole goal is offering people better services at a lower cost. We believe everyday investors earn a fairer fee and greater transparency. All of our information is on www.metricfin.com. And if anybody would like to get on our weekly email where we talk about market summary, financial planning and investing tips, it's called the Factor Report. We email it out every Saturday morning at 8 a.m. Just shoot us an email. You can find our contact info on the website, and we'll get you added to the list. Thanks again, Kirk.
Great. Well, thanks for coming on, Tim, and sharing your wisdom with us. I love that final piece. There's a quote supposedly by John Maynard Keynes, even though I don't think he actually said that, but it's misquoted, like many quotes, misquoted. When the facts change, I change my mind. What do you do, sir? I'm pretty sure he didn't say that.
Isn't that the lead singer of the band Tool? I think that's one of his lyrics.
Yeah, it's good. It's good.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.